There's a bit of an art form to this. There's a balance between having protection and what's the cost. Cost is king. In this particular example, we saved a client $9,000, or will save over the next 12 months.
Holy.
So it's a pretty
my language.
It's a pretty massive win. I saw a quote from a monk recently, and it said that humans have got hundreds of problems until you have ill health and you've got one.
Welcome back to this fortnight's Blueprint podcast. Rory and I are super excited today to talk about a client's success.
Yeah, and it's in my space today, Dan, which I'm pretty excited about. Insurance has been a part of our business for about 6 months now.
Yep.
And the process that we're going to work through in this example, we've been having a lot of success. And what I mean by that is clients are really understanding the advice.
Yeah.
Because there's a bit of an art form to this. There's a balance between having protection and what's the cost. So cost is king. In this particular example, we saved a client $9,000, or will save over the next 12 months.
Holy.
So it's a pretty
my language.
It's a pretty massive win. And we just want to preempt that that's not our goal. To reach outcomes like that, and they're pretty rare.
Yeah.
And a lot of the times we're actually dealing with first home buyers, and so we're not saving them any money on insurance.
Yeah.
We're setting them up for the first time.
That's right.
But it also highlights, the importance of people that have had cover in place for a long time of having a review. And this is the case. But we work through this process with clients who are new to insurance and clients who have insurance. So
it's the same process.
It's the same process.
I think the thing that excites me the most about it is the term that we use. It's a risk analysis, right? Because when people think insurance, they think, it's extra costs I got to pay for. But when you actually take into account what it means for your financial journey, it's a risk analysis. And the structure of your insurance should be actually constantly changing over time. Maybe not constantly, but every 5 to 6 years, based on how your income's changing, based on how your debt level's changing if you're a property owner or an investor, and based on how much your household relies on you.
Yeah,
right?
Absolutely.
Yeah. So I think it's super exciting because it's in our space, it's the most tailored part of it. When you get a mortgage, many times it's pretty stock standard, especially for first home buyers. The recommendation will be pretty similar, depending maybe on how much the deposit the client has. But for insurance, it can be so varying because of how the income of the household's structured, what sort of debt they've actually got, and what their long-term financial goals are, right? But
Absolutely.
we can put that doorstop in for anyone, and then how do you make it fit within the budget? But mate, that sounds ridiculous that we're saving someone $9,000 on their
It's crazy,
insurance.
yeah. You mentioned the buzzword there, risk analysis.
Yeah.
And insurance, we call it a needs analysis.
Of course, that's right. Yeah.
And here at Blueprint, we call it a strategy session.
Yeah.
That's right, yeah. So, but anyway, without further ado, let's have a look at this example.
Yeah, let's tuck in. I love a spreadsheet, hey?
Yeah, let's run through it. Okay, so the first thing that we look at is what cover does the client have in place already? And so in this particular case, I haven't broken it down, but they've got pretty comprehensive cover.
Yeah.
So they've got medical, they've got income, they've got life, and various other products in between.
Already in place.
Awesome. It's actually, this particular case, the cover was offshore.
Yeah.
So there were a few issues with it. The cost was one.
Cool.
The sustainability of the premium was another one. And then there was a bit of exchange rate risk. Because just for where it's based, we won't dive into too much about where it was located and stuff, but insurance is meant to be there as a safeguard and take away risk.
Yeah.
There were a few risk factors with this insurance policy that we wanted to remedy.
I can almost guess the part of the world or the kind of part of the world that this
You know
insurance
it well.
Yeah.
You know it well. Yeah.
And what are we calling our client for this case study?
Client X.
Awesome.
Yeah,
Okay,
yeah.
cool.
So completely anonymous.
Yeah.
So there's to start with, there's 3 areas of personal risk.
Yeah.
So there's medical costs. So we have private medical cover. There's what we call disability benefits. And so there's a few products that fit into that category. There's income and mortgage cover, trauma cover, total and permanent disability cover.
That's right. Yeah.
That's really the crutch of our exercise today, is focusing on those areas, because that's where there's the most kind of juggling numbers.
For sure.
And we'll also look at life cover as well. That's the third category of risk.
Yeah.
So page 2 of our spreadsheet, It's quite basic what we put into here, but we've got their income details. If we're dealing with a couple, we'll obviously have 2 incomes.
Yeah.
And we've broken down their deductions, which will become relevant later on in the piece. This particular client, they've got a $50,000 mortgage, so they're at a pretty outstanding spot debt-wise.
Yeah.
Yeah.
So they're at the business end of their mortgage, almost mortgage free.
They are, yeah. So they're really looking towards retirement and, putting funds away to that. And so that's where their insurance policy was a bit of a handbrake on maximising their sort of investment goals as well that they've got.
Yeah.
So really good debt position, no other debts, a little bit in KiwiSaver, they've got a bit of cash, and that's what we've got. So what we do then is this all carries over into their cash flow statement. And this is what we look at with every single client. And there's sort of 1 to 3 variables here. There's 1 or 2 incomes in the household generally, and there might be some other income if we're looking at someone with an investment property or a side business or something like that.
For sure.
But in this case, you can see that we've got a net income, 5,600, total expenses of 3,800, and then their net 1,700 approximately per month.
Yeah. So it's a basic budget just based on their fixed
It's a
expenses.
basic budget, mate. Yeah.
But the thing that's popping out is the 18% for personal insurance.
Yeah. Do you like that pie graph?
Of their gross income, it's 18%, which is
This is
crazy.
of their gross,
So of
yeah.
their net income, it'd be like 26, 27%.
It's huge, yeah. So, and look, it's not crippling this person.
Yeah, he
They've-
obviously lives well within his means if he's got a small mortgage as well. He's good financially. We're getting a good overview of who this person is.
Absolutely. But there's, it's pretty alarming when your personal insurance expense is almost the same as all of your other essential expenses combined.
Absolutely.
And that's the case here. The first product that we look at is income cover. So on the right-hand side, there's sort of maximum calculation. So there's sort of 2 ways that we can calculate income cover on an agreed value basis. So there's no tax, essentially. And we can insure up to 62.5% of their gross income. Or a taxable income cover, which is subject to tax. And therefore tax relief as well. Even if you're on PAYE, you can claim a taxable income protection.
Oh, that's brilliant.
Yeah, there's not many things you can, but income cover you can if it's a taxable benefit.
Incredible, yeah.
And we can insure up to 75%. So what we're looking at here is if we take away this client's income, the deficit, and so they're about $3,800 in the red. And this varies quite a lot when we're looking at couples, for example, and sometimes we meet with couples who have a similar income. Sometimes there's quite big differences, and so there'll be really different amounts to get this spreadsheet or this cash flow back in the green. So at a minimum, we want to be breaking even. In this particular example, the client actually took the full sum of agreed value. And you can see here, plugging that insurance gap with 4,825 of cover, they're back into the green.
So for some reason he can't work, that's the insured amount he's going to get net in their hand.
Absolutely, that's the one. Yep, that's net, no tax. A couple of other variables down here, what we look at is wait periods and payment terms. Generally, we want a payment term to the age of 65. I mean, in most cases we do. It's the best type of cover for that long-term protection.
For sure.
It's going to cost a bit of money to do that, and so that's why getting the sums insured correct, reasonable is important. And then the wait period. So in this case, we've gone for a 13-week wait, which is, again, that's what we aim for. Seems like a long time, but it's the best period to maximise efficiency in terms of the cost of the policy.
For sure.
And the reason we can justify a 13-week here, the client's got $20,000 of cash. He's got some KiwiSaver. We don't want to touch that if he's ill, but he does have that. But the cash, he's got enough cash to get him through 3 months.
Brilliant.
The next disability benefit we talk about is trauma cover. So there's lots of different ways you can spin this, right? And different advisors will do things differently. So we can do multiples of income, gross income, net income. We can cover mortgage or total essential expenses. Or we can just do a generic amount as a recovery fund type thing. So the way we do it is we look to plug the gap from income cover and the client's net income. That's how we do it as a starting point, right? And so in this example, we've got 10 years of cover, which means that the income protection with the trauma cover of $100,000 means that there's no financial loss over a
You're
period of 10
topping them
years.
up for 10 years.
We're topping them up
Nice.
for 10 years.
Yeah,
Yep.
awesome.
So that's got them covered in most cases.
Yeah.
And a lot of the times we only look at sort of 2 or 3 years.
Yeah.
And that's typically because we've gone for a lower sum of income cover. But this client's got a lot of income cover, so $100,000 covers them for 10 years.
Brilliant.
Total and permanent disability. So with this one, it's worst case scenario, right? You can never return to work again.
Yeah.
So it's a pretty tough diagnosis. Again, lots of different sort of ways we can calculate it. We can look at debt, replacement income, and again, just generic recovery funds.
Yeah.
So this case, we've gone 25 years, total income replacement, which takes this client to age 65.
Yeah.
So it's $150,000 of top up. It's a pretty small amount of permanent disability.
Yeah.
He's got the to age 65 payment terms, so he's pretty well covered in his income cover.
Brilliant.
This is just this a little top up.
So is this pretty similar? I know you're going to get into it in a second, but this is pretty similar to his existing cover, but it's also a new recommendation based on his current situation, right? Because his current cover is also not quite fit for purpose with what he's paying, right?
Correct.
Yeah.
His current cover is like quite different, to be honest.
Yeah.
So
Yeah.
when we're looking at, and because his cover was comprehensive, we do this type of review.
Of course.
Some clients might just want to price check the market and
Yeah.
they go, I've got $1 million worth of life cover, $200,000 worth of trauma cover. This is what I'm paying.
Yeah.
Am I overpaying?
Yeah, for
And we
sure.
quote the market and go, no, it looks reasonable,
It's all
or
good.
no,
Yeah.
you are overpaying. And oftentimes we can save money in those cases could be like medical loadings, things like that haven't been reviewed.
Yeah.
So now this client, this structure is completely different for this client.
Awesome. Yeah.
So that's TBD. For medical cover for now, we'll skip that, Dan, because there's not a lot of calculating that goes into it. We choose an excess and we discuss
It's
the
pretty
product.
straightforward.
There's a bit to it and kind of like how it works alongside the public health and ACC, etc. But for today, we're just sticking to the crunchy numbers.
Oh, yeah.
So the last benefit was life cover. So earlier on, we saw that this client had a $50,000 mortgage left, no dependents. He didn't have a great need for life cover, so he had a reasonable sum existing.
Yeah.
But, he's got a lot of equity in his home. He's got some cash. He's got some KiwiSaver. We've gone with $50,000 of life cover just for final expenses, legal fees, a funeral, that sort of stuff.
Yeah.
And you can see that gives him a total estate of $900,000, excluding, his car and his contents and stuff like that. So
Yeah.
he could have had $0 if he wanted. So he's
Yeah. See, I think this is a great example of a client where, because of his life stage, he's utilizing the other products where most people, it will be based around the life cover, right? Then you've got your accessory of your TPD, your trauma. But this guy, he's able to just lean on the other products more so than the life cover, because it just doesn't make sense for him to have a big lump sum. He's got his house nearly paid off. He's leaving a legacy there,
Absolutely.
so he doesn't actually need it.
Not at all, no. No, 100%. And, medical and income was really important for this client. And so that's what we've done.
Oh, incredible.
So the last thing we do, Dan, is sort of bring it all together and summarise it. We also then look at what's in place.
Yeah.
So what are we looking at in terms of our recommendation? What's in place? Is there any areas where we think the client's overinsured or underinsured? And then that becomes a conversation with the client.
For sure.
So this client had a ton of insurance, right? But for this exercise, we're not going to do like a product comparison or benefit comparison, but that's what we do at this stage. So once we've done that, we go and quote this up. And so we'll show the viewers what we do for that.
Quote monster.
Quote monster.
This is a very iconic page for insurance advisors in New Zealand.
I couldn't do my job without it.
Yeah.
I could, but it would be a lot more difficult.
Yeah.
So this is a great tool. Big plug for Quote Monster here. But what we do is we put in our client details, and then you can see here a list of benefits that we can select. So I haven't actually quoted this entire package because I don't want to kind of highlight insurer pricing and price differences. So I don't want it to be about that. So I've just done a little nominal amount of life cover and trauma cover. But you can see here that it quotes the market, and with the benefits that I've chosen, there's hardly any difference in price.
Yeah.
With this particular package, it's quite a lot of difference in price in reality. Yeah, we don't want to get into the weeds and like different companies and stuff. So the other thing we can do here while we're here is I'll highlight it, is if we're looking at replacing benefits or even just recommending benefits in we can go in and compare.
Directly compare
Yeah, directly compares.
Existing or other options. Yeah.
Absolutely. So, like, for example, if we were looking at trauma cover, and I've just selected A and ANZ. ANZ doesn't have a rating. Let's just do B and Z. And we get some benefit scores, what's covered under a policy, what's not. So you can actually see here. So this is AIA is one of our main insurers, and BNZ Life. It's actually been taken over by Partners Life now, but so these products aren't on sale.
Yeah, that's the old policy.
They're old policy, but you can see here there's 15, 20 odd conditions covered by one company that aren't covered by another. So like blindness, you could hold a trauma policy and go blind, and one company pays you out and one company doesn't.
Yeah.
And I don't know about you, but I think going blind is a traumatic condition.
100%.
Yeah. So the main providers, you won't see big differences like this.
Yeah.
But we do see it elsewhere in the market. So anyway, we quoted up, Dan. We come back to our spreadsheet. All right, Dan, so we've gone into Quote Monster. We've got our sort of starting package and we've quoted it up. Then we come back and we want to present this in a way to the client. We see what it's going to cost as a percentage of their income.
And present it in plain English.
Plain English, mate.
Yeah.
Absolutely. And this is really important because, like, you've just gone through a bit of this process with me and a lot of talking from me and all these different products. And by the time we get to this point, clients are going, what is this going to cost me?
Yeah.
And I tell them, look, we will get there.
Yeah.
We'll get there and we'll make it work. We plug it in here. So I've got a few numbers up here. So you've got the ACC deductions on a monthly basis and their KiwiSaver. The kind of rules of thumb that we work to. So C's an insurance for accidents, and it's generally about 1.6% of gross income. The rules of thumb that we work to, as we know, ACC is an insurance for accidents.
Yes.
And it's generally 1.6% of gross income.
Yep.
Slightly less on higher incomes. There's caps to ACC because there's caps to the replacement. Yep. And then the minimum KiwiSaver contribution that most Kiwis are doing is 3%. And so what we find that an insurance premium in that range is generally affordable, and we can often get the package that we've just gone through.
For sure.
With medical, it can be more expensive, so it can go up to about 5% of gross.
Yeah.
Higher than that, obviously depending on the client situation, and it's a little bit steep.
Yeah.
So at this point in time, I plug it in, I see how it's looking, and then I'll go and do some amendments based on what I would look to do first.
For sure.
To refine it and get it down to a more comfortable level.
Yeah.
Obviously, like, clients have the final call and they're the ones that...
They know what's important to them, right? Because some
Absolutely.
people might prioritise private medical cover over a trauma policy or a TPD, you know?
Absolutely, yeah. And I might put together a package that's 2% of someone's gross income and they say, you're dreaming, mate.
Yeah.
You know, and I go, cool, well, what's your budget?
Yeah.
And then we work to that. And then I'll guide you on what amendments I would make based on your budget.
Yeah.
And that's absolutely fine.
So you'd say 2% and they'd say you're dreaming as in that's too expensive? Or
Yeah.
Okay, yeah.
Sometimes people want more.
Yeah, of course, yeah.
Yeah.
Yeah. I think I'm over 3%. I'll have to look at it again, but I try to at least stay above in that 3 to 5% region of cover.
Yeah.
I think that's where you have to be. Because just the key things that we're looking at here, like the 3% to your KiwiSaver, you have to keep that going in an event that you can no longer work.
Yeah.
And people just forget that your income is your biggest wealth building tool over the length of your life. You have to keep those contributions going. You have to keep the consistency there.
Yeah, 100%. I saw a quote from a monk recently, and it said that humans have got hundreds of problems until you have ill health and you've got one.
Yeah, exactly.
And so with this insurance is we don't want finance to be one of them as well. If you fall ill.
Yeah, 100%. I thought you said for a second you quoted a monk. Like you're doing a policy for a monk, which I would love to. That should be our next case study.
Yeah, absolutely. So anyway, mate, back to the Destroy Boys. We've quoted these benefits, $160 a month.
Yeah.
We've actually suggested they retain some of their current cover, which is $223 a month.
Yeah.
And we're around about just a shave under 5% of gross.
Brilliant.
So I've taken this to the client. I've also got a few other options up my sleeve. And
we're at 4%.
We're at 4%.
Yeah,
so this is pretty good. And they've got medical, they've got really comprehensive income cover.
Yeah.
If we recall from the cash flow initially, we're at 18%.
Yeah.
So we've shaved off more than 2/3 of their premium, which was over $1,000.
And giving them a similar amount of protection. We're not taking too much stuff away, right?
No, and just like we're giving them what they need at this current point in time, explained it in a way that they understand through this process, 100%. And they've gone, absolutely, that's what I need. Yeah. So in this particular case, we go through, usually when we're amending benefits, so this is what we just touched on then, we're making it more affordable. In this particular case, the client wanted a bit more certainty over premiums, because one of the things that we were reviewing with their current cover was unsustainable increases in premium.
Yeah.
So we made some amendments, and with their life cover and their trauma cover, we've gone level to age 65. Total and permanent disability income cover, we've leveled that for 10 years as well.
Yeah.
So giving them certainty, and they were quite comfortable with the increase in premium. The increase in premium put them up to around 7% of their gross income.
Yeah, awesome.
So we've saved them 11%. Over the next 12 months, we worked it out, it's about a $9,000 savings. So over 10 years, the current policy would have more than doubled.
Yeah.
And this new policy with these leveled premiums is going to have really gentle increases. So over 10 years, $9,000 in year one, you do the maths, and with that client intending to invest that money.
Yeah, I was just going to say. If he does,
6 figures over 10 years for sure.
Oh, at least, yeah.
Yeah.
And in the next 10 years, that compounding effect of that cash, it just grows exponentially.
Yeah, absolutely.
For our clients that wouldn't know, level versus stepped. Level cover, explain from a guy who's not an insurance advisor, so you can correct me. Level, the price is not going to change over time. It's going to change a very small amount. Stepped, it's going to increase with your age and with CPI and that sort of stuff, right?
Correct, yeah. So pretty much correct. So with the level premiums, they won't increase for age.
Yeah.
And that's the biggest
just for
increase.
CPI.
They could increase for CPI if that's attached to the policy, and they could also increase, unless it's guaranteed, if the insurer increases their product.
Of course, yeah.
Due to claims experience.
Yeah.
Some providers will offer guaranteed level on life cover only because it's quite predictable in terms of claims. Trauma cover, you don't generally get a guaranteed level premium. If it increases, the product price increases.
For sure.
Everybody wears that,
Yeah.
but you won't get age-related increases.
Yeah.
Costs more initially, saves over the long term.
Awesome.
So really good if you've got, a need for cover and you can see the need for it longer term to flatten it out, or if you just want absolute certainty over what you're going to pay year over year.
Very good. Oh, cool.
This is how we do it, mate.
Dude.
Any questions?
No, man, that's awesome, eh? Honestly, it's making me think that I need another insurance review with you, even though we just had our review like a couple months ago.
Yeah, well, this
I just want another one, eh?
Yeah, no, mate, let's absolutely. I think we can upsell you.
Yeah. I need some extras, eh? I need some frills. Having this after you having the mortgage strategy session, it's so important because we take so much time and effort. The clients work so hard to get debt-free faster, make sure they're investing in their retirement, work on investment property. If you don't have your income, that plan's not going to go ahead. And when we forecast a retirement amount of net 6 million, 7 million, which is what you need to safely withdraw the funds for your retirement, that's just not going to happen. So it goes hand in hand, and it's a really nice transition for our clients to make sure that we're on the right track. So
100%, yeah. And we're probably looking after about half of our clients' mortgages and insurance as well.
For sure.
Which is really great. And the other half have got their own arrangements.
Yeah.
There's a couple that don't have insurance. But it's a case by case, right? And everybody's, does their own thing.
Oh, awesome. No, cheers, Roy. That was awesome.
Thanks, mate. Thanks for enduring that with me.
All right. Well, thanks so much for listening, guys, to our existing clients, our referral partners, our business partners. We really appreciate you guys supporting Blueprint, and hopefully you guys found some value in this episode. And we'll be back soon. Cheers.
Cheers.